We're back for another episode. It's Arjun Paliwal, Head of Research and Buyer's Agent here at InvestorKit Buyer's Agency. And I wanted to chat to you about today's episode. So we're catching up with Tom Newman from Summit Finance WA. That's SUMMIT, so two M's on the Summit. And Tom is actually a really specialized mortgage broker. He helps with investment properties and investors start scaling their property portfolios. And where he comes in is that really ability to become more creative, become more solution focused, and always come in with the thought of, wait, you're not stuck yet. There's an opportunity. Let me find something for you. And so there's very few out there who come with solutions and too many people out there who come with the problem. Look, if you're catching up with a mortgage broker and you're struggling to move from the second to third to the fourth, you probably already know your problems. You don't need another problems-based person to join you on the problem discovery. You need someone with solutions. And this is where I speak to Tom regularly, because Tom has not just done it for a client, but multiple clients who've worked with us to be able to get their portfolio up that extra notch. And this is very, rare when it comes to certain mortgage brokers. And so Tom is one of those people who actually enjoys the complexity, right? And the complexity of finance and trying to find that solution. And so this is where I love chatting to people like that, because they truly care about their clients. They truly care about that solution finding mode. And I've probably mentioned the word solution now like 100 times, but you know how important it is. And it needs to be there because, as they say, property is a game of finance with houses thrown around. So tune into this episode as I dig into Tom's thoughts around investor psychology, around scaling, the thinking that the right broker should have, some creative ways as well to help. And then, of course, some other tips that he's got in terms of helping grow that lending capacity and lending growth further. Jump in, and if you want to reach out to Tom, you can catch him on LinkedIn, Tom Newman, or you can jump on summitfinancewa.com.au. Check him out. Tom, this has been a long time in the making, mate. Thank you for joining me on an episode of the InvestorKit podcast.
No, you're welcome, mate. It's definitely been a couple of years in the making. So thanks for finally reaching out and allowing me to come on.
Look, I mentioned it in the intro. I'll mention it once more here. We've collaborated on many clients when it comes to helping them, whether it be starting their portfolio, scale it with some significant moves, and then even high net worth starting to figure out what they need to do and how they get to the next level. And so I thought it'd be good, instead of us having the cool chats behind the scenes or our clients getting the cool results, we come out and share it to the world, a couple of the secret sources, a couple of the practical tips, and also the psychology the top clients that we often see have, so that people who are on their way can start to bring this to life, right? So, mate, thank you again. But with regards to that, I think let's start off with the first part. There's investors who come into the journey wanting to achieve something, and there's investors who come to the journey actually achieve something. And if we put income, the broker, the buyer's agent, everything aside, what are some of those things that you see psychologically certain investors have that work with you, that do end up doing well? Or if they don't have it from the get-go, what are the changes you see as time goes on that gets them to eventually get it? Would love to hand the mic to you on that.
Yeah, sure. So I think really, as you mentioned, there definitely is a clear disparity between the two people, and some get there by sheer mistake, or some might say luck. Others get there with a more clear defined purpose. And I think some of our clients that we've dealt with that have kind of gone from where they thought of one, whether it was just one property into three, or whether it was three into six or 10 or so on, was the biggest factor, I think, in that. Put aside all the crap, the income and everything else, and the lender policy. Put that aside. The number one thing has been an end goal, and then everyone can have an end goal, but you've got to couple that with the actual action, because there's so many clients that we've dealt with in the past that have said, and it's common, you probably hear it all the time as well, I want 10 properties in 10 years. How much passive income do you want? 100 grand. It's the absolute gold. It's the gold-plated solution, I think.
And then whoever, by the way, that said the 10 in 10 years and the number 100 grand, someone, can you find them for me? I want them on my marketing team, because they, like, every single person in Australia says, I want a passive income 100 grand. It's like, bang. Could you imagine how little, by the way, 100 grand will be in inflation like 10, 20 years down the track?
Exactly. And then when you kind of start to unpack that, you say, well, okay, where does the 10 properties come from? Well, and it's almost kind of like, hats off to anyone. You've got a goal. That's great. But then you start to unpack that and go, well, why 10? And it's not, it's almost baseless because it's just it's so commonly, I guess, repeated that it just becomes like a self-licking ice cream in the sense that everyone now, it's 10 properties, 10 years at 100 grand. And then when you kind of get an Excel or whatever your strategy or whatever your sort of choice of platform is out and start actually extrapolating that, it might only be 3. It could be 20. It could be, it's that's one aspect of where some of our clients have been able to get to, going from like where they started at, let's say 3 properties to getting to 6 has just been A, the goal, and B, the actual action to get on with it. So you give them the borrowing capacity, you talk about the different strategies that between lender policy, structures, and ways that they could potentially better their own income to actually get to that 6 or 10 or whatever they want. Then you've kind of probably got the others that I wouldn't say they don't have the goal. Everyone's got the goal. Everyone wants to achieve the same sort of financial freedom. But it's really, we can structure a plan for that from the lending side, but they have to structure their own life plan, I suppose. And that's where a lot of the times we'll see things fall over, and the real disparity between those that end up ultimately getting on with something and those that sort of want all their ducks in a line before they actually start cracking on. And some of those ducks in a line are unrealistic. As we just said, the 10 properties, 10 years, 100 grand for a lot of people is particularly in this current lending environment is unrealistic.
Yeah, I think what you've touched on is 2 core parts: is not just having a cool idea for the sake of it, but actually having some real clarity behind it. And then the second thing that seems to be coming up is actually living the life of the person you want to be. Do you know what I mean? So you're not going to get to 100 grand passive, build a huge portfolio if you can't put a little bit away each month to be able to handle slightly higher rate environments, to then even cover mortgages, right? That's not going to connect. Like, it's like the mindset's here, the goal's here, but the action's here. So I get you, right? Putting those 2 together. What about something I've noticed? And I wanted to just, out of curiosity, see if you've noticed it. In some of my clients that we've worked with, I've noticed the clients that end up asking 1,000 people for their opinion end up also displaying those traits to be stuck, and they tend to achieve less as well. Mm-hmm. And I'm not saying people shouldn't be informed, but what I mean by that is the person that goes, I want to pay for professional advice, then I want to go to another person who's another professional who specializes in something else, then I want to go into multiple forums, then I want to go into questions that I ask my uncle and auntie, and then I want to go there, and then I want to make my own opinion. Research doesn't matter anymore. And so it's like, do you see the same world in the finance world when you see certain clients who maybe don't do that and they set themselves apart?
Yeah, I definitely would say that we do. I'm just trying to really think of a good example of where we've kind of had it day to day.
And I guess while you're thinking of that, maybe even also trying to imagine how, like, has that been different from the clients who've, like, have you noticed any performance differences from clients who've just been so, like you said, goal driven, selective, in going where they want to, understanding, and then instead of using opinions to guide them, they make decisions based on, I guess, where they want to go or the facts that they gain on one path.
Yeah. I think for the most common problem for those people that you could probably say, like, and you probably coined the term, maybe that analysis paralysis, where there's so much in the world of property, there's so many books, there's so many, like, the thing I love about property is probably the actual negative in what we're saying here is that I like property because every book that you read about people that have made good money and sort of self-made have done it generally through real estate as opposed to other investment options. But then because of that, there's so many different strategies, different ways that people have achieved that wealth through property. Yeah. So then there's obviously that confusion for a start. There's the type of asset. Do I go 50-50? Do I go residential? Do I go commercial? Then within that residential, do I go units, townhouses or houses? Do I do a development? Do I do a renovation? And then even in the buyer's agency world, there is so many different types of buyer's agencies, so many different strategies that other people have had success on, that it's no wonder that there's people like that you and I would see every day that can't make they can't make a decision, and B, there's too many decisions to be made, too much information out there to really narrow down exactly what they're going to do. But that being said, I do find those that can ring a professional that don't. I mean, shop around by all means. You've got to speak to the right people, and you've got to be able to. If you don't gel with that person on a sort of both a professional and a personal level, then forget about it. But you then have to make some sort of decision in your own life. No one's going to give you that silver platter. So when you ring someone, and whether it's your broker, whether it's your buyer's agent, whether it's your accountant, and you go, okay, I've had a chat with a few of them. We seem to be able to, I like your philosophy or whatever it may be. Once you go with them, then rely on what they're giving you. Rely on the information you've chosen for a reason. If they can give you, whether it's in my world, if I can give you some numbers for your borrowing capacity or the way that I think you can achieve certain things, then take that, stick with it, and then see it through. Because the number of times that you pick up the phone and someone says, especially in my case, oh, I've got another broker that I'm chatting to, and straight away you just think, okay, well, that's fine. I don't mind. Call 5 of them. This is my chance to give you my philosophy and really sell myself and my sort of testing out my value propositions, really. But once you make the decision, the ones that I've seen go far have been the ones that have stuck with the plan, and relied on professional advice.
Yeah, so we've touched on a few psychology related things that have helped, and biggest takeout for me is really just that end goal in mind, coming back down, and then taking those steps and living the lifestyle to achieve that goal, right? So I think in that aspect now, when I think of the next part, what comes to my mind is the solutions you've deployed in helping many people start to scale a portfolio. And look, I know we could take this in so many different angles of what that looks like, but I think one of the hot topics around has definitely been the world of, trust, the world of multi-banks and achieving things through different policies. For those who are new and suddenly maybe just go, wait, I thought you just go to your bank, go to the same bank and keep going there. Or I just thought you called the broker, ask them for the best rate, and they go get you capacity. How does that mindset differ from some of the solutions you've been applying for people? And could you maybe give us some insight on some of the solutions that actually help you start really scaling a portfolio?
So I think the number one thing, I mean, there's thousands and thousands of brokers out there in Australia, and everyone's got their own niche. From that niche, everyone's got their own software that they use. Some of them stick with a handful of banks. Others have accreditations with tons. And just because you have accreditations with 40 banks doesn't mean that you write loans through 40 of them. No one typically does. Where I've really quite relied on, like my background prior to broking with the military was working in communication. So I definitely try to adopt some of that newer tech into the business. So straight away, whenever the biggest wins that I've had with clients that ring up and say I'm maxed out, I always just say bullshit. And I say bullshit because in the nicest way possible, because there is a solution for you. It's just whether you like the answer or not. And what I mean solely by that is there's so many non-bank lenders in Australia. There's over 200. There's over 200 and something banks, what you would say, and what most will know is the big four plus a couple of the second tiers and maybe one or two common names in the third tier lenders in the non-bank space. Outside of that, there is so many banks. So I always say that you will have the borrowing capacity. It's just whether or not you want to swallow the 8% interest rate. And we've done plenty of them. We've done plenty of 8.5 rates with non-banks as a short-term strategy. And that's what I've stressed to every client. We've been able to squeeze that last property out, or that second last property into their portfolio. It's like, this is not a long-term solution. This is a short-term strategy to get a property over the line, very similar in the development world or the commercial world. You might be doing some sort of 5-year short-term finance for an overall longer-term strategy of refinancing, or when this happens, then we'll do something else. So I think that's a quite big wins, and being able to adopt that platform where we can, with our 10 minutes on the phone with a client, chuck in all their figures, and then put their figures in the left-hand side, see on the right-hand side all the banks, what their capacity is, what the rates are. That has been a game changer for me and my business, and I think it's been a real value add to clients, because though that's the biggest win. When they ring up and say, I can't lend any more money, give me 5 minutes. Okay, you can lend a lot more money than you think.
On that note, Tom, one thing that stood out to me, just in the language you've used so far, has been not about finding the solution, but more so finding the solution and letting them know that you don't have to be here forever. You know what I mean? That's a big part, because some people assume that, hey, my broker's given me an 8% rate to buy this next place. Is that a good rate? Imagine that. And that conversation immediately, it's like, well, no, it isn't. But what do you want to achieve? And I'm here to tell you that the information you've given me, the trajectory you're on, where you want to go, and where interest rates might be in the next year or two. This might not be a forever thing, and we're going to help you eventually come back to the parties where the money saving comes back again. And you've reminded me of something of the importance of an acquisition phase. And when
Yep.
you're in an acquisition phase, it's not on your interest to buy properties forever. Like I tell my clients, I don't want you as my client forever to buy. I want you as my client to buy for the shortest period of time, because the most I can build your asset base in the shortest period of time is the more compounding wealth you have over time, the more you use inflation and leverage to your advantage. And then you can sit back and go, well, now we can just go to check-in phase. And you've hit that on the head there, because you're like, well, if I equip you with the solution, so it's BS on your borrowing capacity being capped, are you willing to pay the cost for it? And are you willing to look at me and just know that this is temporary? It's not forever, because we'll get you that extra place. We'll get you that extra one. So yeah, I just wanted to point that out. But sorry to interrupt. I know you were going to
No,
start
it's good.
on.
I was going to, before I get onto that, I was just going to say, like, none of this, yes, your property purchase is a transaction, but none of it should just be a transaction. Like, it's in the sense that the entire thing, whether it's 10 years, 20 years, 30 years, it's a long-term plan. It's not you buy the property and the transaction is done. And the same, it should be the same with your broker, your accountant, or your buyer's agent, whoever. That yes, there's a transaction in place, but with me, there should be at least the plan of, as I mentioned, a short-term plan with a particular bank. And if it's not going, if it's not what you actually what your intended solution was, it's a solution for a short period of time to get to where you want to be in the future. Which, whether that requires, the whole thing is really requiring some level of sacrifice in some way, shape, or form. Whether it's second job, large, trying to really scrimp and save, whatever it is, you've still got to be able to put that effort into to sort of to come up with that. So yeah, certainly. And then going into the next thing, which is the trust. I've definitely noticed since I started the company and was really getting into the world of finance, trusts were definitely a bit of a dark art in the sense that it was, well, don't worry about the trust until you're onto your 10th property or until you're on the 5th property, whatever the case may be. And it was definitely considered one of those more really wealthy strategies that were deployed. But where I think there's some great wins, there's actually a lot of inherent risk involved, but and I can explain it later. But the thing with the trust is that the number of clients that ring up and ask the question, should I be buying in a trust? I can obviously talk for days on the lending side of the trust, but then obviously the pros and cons in terms of the overall structure with your accountant is obviously an accountant question. But where it really comes into play is to be able to hold a property in an entity that, and particularly with the trust, you have the trustee. And with the trustee, you can have yourself or you can have a company. And the benefit of having the company is that's a legal entity that would hold the property on behalf of the trust. So where it actually helps with servicing, it doesn't increase your borrowing capacity. It doesn't decrease your borrowing capacity. If the certain metrics are met, if you can buy the property under the trust and the property is very highly positively geared, you don't need to put any money into this trust anymore for it to continue to service its debts or for the holding company. Now, most lenders, if with an accountant's letter to verify that the trust covers its own outgoings, without you having to contribute, then the debt you hold is only whatever you hold in your personal name. So for a lot of people, that might be your own occupied property. It could be your first 2 or 3 investment properties. But where we've been able to use this strategy effectively has been really getting from, particularly in these high rate environments. Commonly, I'm finding most people are sort of maxing out at the moment between 3 and 4 properties. And it's really hard, again, to sort of take that next step to maybe you're going to a non-bank lender with a really high rate and it really kills the deal. Or you're kind of just sitting there waiting for an event to happen, whether that be rates lowering or your income improving or something like that. Where we've been able to apply that effectively has been not where you've maxed out your borrowing capacity, but where you've got some left to be able to purchase your next one under this trust arrangement. And again, it can't just be any property. It has to be the right asset with the right cash flow to be able to service its debts. We'd then be able to negate that entity's income and its debts going forward. So a typical scenario where we've had this applied has been somebody that's got 3 investment properties. Maybe they have $500,000 of maximum borrowing capacity left with most of your sort of tier 1 and tier 2 lenders. They then purchase a property under, we'll say, Arjun's holding company proprietary limited as trustee for Arjun's property trust. They buy that 4th property under that trust. It covers itself. Accountant verifies this through reviewing the financials, writes a letter. We can then go to the bank and again, they'll say, how many properties does this customer have? How much debt do they have? Well, they've still got 3. they've got 3 properties, they've got three rental incomes from this property, they've got 3 debts tied to the property. They do have a fourth, but the fourth is in the trust and it covers its own debts. We don't include the income of the trust, therefore we don't include the debt. Borrowing capacity stays at $500,000 again at the start. Obviously, if rates go up, you're going to still have your borrowing capacity drop because you still have, the standard servicing still applies, but you'd then be looking to borrow again under either a new trust or under the same trust that holds a property. So that's been a real game changer for a fair few clients. I think the inherent risk is that obviously if you go to 10 banks with 10 trusts, with 10 company trustees, you can see how eventually you do sort of stack everything up like almost like a house of cards, because you can get to the point where what if they're vacant for a longer period of time than you expect? What if you don't have cash buffers in place to handle that shortfall? Then the trust does need income from you, and if your income is being just spread super thin by buying 10 properties under 10 trusts, you can see how that's obviously from the bank side they say, hey, man, they're perfect, man. But then from your side, you need more due diligence on your side than what the bank has done on you.
You raised a good point. It's like everyone's looking for the hack to buy more, but can you handle more? You want the truth, you can't handle the truth.
Yeah.
Like that sort of stuff, right? Like if you can't handle it, what's the point? All the strategies in the world are great, but you nailed it. It's like, hey, there is a risk that comes with it. I could buy you that extra 1 or 2 properties, use servicing smarts. You got to be able to handle it. And like you said, there's going to be moments where even though it's positive, there could be that. Now, in this environment, this is me getting crafty, just trying to see how far this goes. In this environment, positive cash flow properties can be near impossible. They can be possible with the deposits you put down. They can be possible with the interest rate you get and the rent you get having to be super crazy. Or they could be possible over time, right? Someone might buy the property in a trust today, a couple of years of rent increases, debt staying the same, rent interest rates come down a bit, and suddenly it's positive. Can you make the trust positive? And I'll give you an example of what I mean by that. I am a separate entity to the trust. Can I make a distribution from my other entity, ABC, whatever it is, or my business, or myself as a person, make a distribution to the trust, call it an income, and then the accountant is then saying, well, technically, yes, this trust is trading profitably because incomes, rent, A line item, B, distributions from other entities, versus expenses, C, the mortgage, the bills, is still positive. Do the banks see it in that way, or as soon as the money that's non-rent that comes into there doesn't count? Because my imagination here is that you're still lodging a tax return, and the tax return says it's positive because income from A, income from B source equal more than expense. Just want to understand, because to me it still seems like it's covering itself, but just requires a few more hands to help.
Yeah, I have seen, and again, it sort of largely depends on what the accountant would be happy to class as sort of to verify essentially. But I mean, if to answer the question in coming from my pocket, if it's coming from my pocket and I'm doing that as an income to the trust, then the banks are sort of asking, does this trust require any additional income from me?
Yes.
To service. So the answer would be no. Then that letter wouldn't be able to be written. And if you then supply the tax returns, you'd obviously see that it's getting some income. And where's the income coming from? It's either coming from trading, renting, or from me. From other entities, you could certainly do something like that. You could certainly. I've seen in the past where even the individual at the start has put a large amount of capital into the trust. So they might have had $100,000 deposit. Property they purchased only needed $80,000. They've taken 20 and just lent it to the trust. Then you can. I mean, the trust has obviously a liability to me, but it's got enough capital there to fund itself for the foreseeable future, which is a tick. And again, that's what I'm saying. It definitely depends on who is writing the letter and what they're comfortable writing, because if that entity does look after itself and needs nothing from me and it's got efficient capital, then all's happy. But ultimately, where there has been some stuff in the past, probably the last 12 months, the whole industry has had letters coming back and forth from their industry group about writing letters that state the profitability of these trusts or certain holding companies. And they even want the future profitability. And as an accountant's not going to write you what the future profitability of the trust is or the holding company, because how can they? And even if they look through all your past financials, there's nothing to guarantee any business future profitability. So sometimes we've been able to get around this by simply just going back to the bank and saying, hey, the accountant's not going to write this. They're not going to write what the future profitability is. They're happy to write fact as of today, based on the past 2 years of tax returns they've lodged for the entity, but we can't comment on the future profitability because ultimately the liability then lies with that accountant company or with the individual accountant, and no one wants to take that risk for somebody else.
Yeah. And does this become a trust thing only, or is this a company thing only, as a company thing as well? Like example, some people do buy properties in companies alone. Is that part of the game?
Same thing. So any other entity that is not you as an individual can have this strategy applied. So if you're buying property under a company, maybe it's solely set up for a holding asset company, you can certainly do the same thing. So the bank cares about you as an individual. What debts do you hold? When I run a credit check, I can have a look at all your debts from CCR reporting entities, like most of your major banks, second tier banks. I can see what personal debt you have. Then at the very bottom of that report, I can see commercial inquiries, and I can see that you have you might be a director of a particular company. Then all the bank says is, well, I'm not going to look over 4 companies. Can you just confirm the profitability, or not the profitability? Sorry, can you just confirm that they're sort of looking after themselves, basically?
Great points, mate. And I think for anyone tuning into this, it's important to recognize Tom is giving the lending smarts, right? And when you're looking at the lending smarts, that's just one angle. If you want to make sure you're doubled up on the comfort or even just the knowledge or advice or guidance from the accounting side, I've actually made a 3-part masterclass with the man himself, Jeremy Ionizelli from KHI Partners. You can go back to some older episodes and see that 3-part masterclass. We talk about trust. We talk about, when it makes sense, when it doesn't make sense from an isolated accounting view. How good is it if you take the accounting view with the lending view and you start putting them together to create the decision of when's right? Now, Tom, we love giving some quick wins away to our audience. So they've got the psychology aspect today. They've got the aspect of trusts and different solutions, and also just the multi-layers of banks, giving hardcore importance on broker versus banker. But what about the last part? Some quick wins on borrowing capacity improvements people can make to A, look after their borrowing capacity better, but B, also squeeze in that last asset outside of what you've mentioned before.
So really, one of the biggest things, I think, if you're ever thinking about starting your property journey, the worst thing I think you can personally do is get a car loan or any sort of short-term personal loan. If you have an asset already, you are, in my opinion, you are far better off to use equity in that asset to purchase, whether it's a smart buy or not. Purely from a borrowing perspective, you're better off to have as minimal repayments per month on any debt as you can to extend your borrowing capacity. And interest only is a great way to do that with certain lenders on debt. Obviously, there's risks involved in every approach that you go with here, but the biggest killer that I ever see in this industry is car loans. Car loans, personal loans, but mostly car loans, because the reason why is because their term is so short. They're maybe $60,000 to $70,000, and everyone loves a 200 series Land Cruiser, and it's obviously more than that. But the repayments are over 5 years. They can go out to 7, but then you change the year in which you buy the car, how old the car is. In some instances, those car loan repayments per month are more than what having an owner-occupied mortgage repayment would be.
Damn,
so,
unreal.
Yeah. So that, as soon as you add that into a calculator, and you've got someone that can maybe afford $450 to $500 as their borrowing capacity, you pop that in, bam, they're down to $250. And the biggest thing is just like, if you've got the savings there, wipe it out. There's smart times to have it and borrow money for assets like that, and then there's times where you probably don't want to. So I think if you're thinking about getting one, think of a different way. Drive a crappy car. I've been driving a silver Kia Rio from 2008 for many, 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 many years until I finally.
Dude, my best acquisitions and my most intense period of acquisitions was driving a $1,000, 2000, I think it was 2000
Yep.
Mitsubishi Pajero.
Yep.
Like my $1,000 Mitsubishi Pajero was the moment I had the best ones in my portfolio because there ain't no car loans.
Yeah, man, you just got to swallow the pride for a little bit, maybe your ego, drive that crappy car for a bit. But hey, if you're putting a little bit of that everyone sort of says instant gratification off for a little bit further, and you can say, man, I'm driving a crappy car and I didn't spend $70,000 on cash on a vehicle or whatever, or financed. I just dumped it into property, and I've got myself something that I can put onto an Excel spreadsheet and project out long term, and I'm going to have a passive income in 5 years, 10 years, 20 years. time.
Absolutely. Absolutely, man.
And I also think that the biggest win comes from within as well in terms of your realistic expectations. Again, going back to the 10 in 10 years, it is very unlikely that you will have 100 grand passive income in 5 years' time if you're starting out your journey. And there's obviously, there's obviously rarities that happen and people do achieve it. But I just think overall, if you took the average of all the clients that we deal with day to day, and I'm sure it's probably the same for yourself, getting to like 100 grand passive income requires a number of properties to be owned outright, or a lot of properties to be leveraged. Having a long-term plan is way better and way more likely to succeed than having that short-term. Have a goal, man. Grant Cardone, man. He says straight away, you want to 10x every goal you have. So if you want to get 5 properties and have 100 grand in 10 years, or 10 properties, then have the goal, but still be realistic in your reverse engineering or your process to get there.
Mate, some great tips, Tom. Thank you for joining us on the show. And for those who are really listening and going, this guy speaks my language, from investor psychology to thinking long-term, goal-orientated, to coming up with solutions to get me unstuck, but also like actually taking the time to work on the numbers and talk about pros and cons. How do people get in touch with you and your team?
So you could either jump onto Facebook, or on Facebook, Instagram, Summit Finance. You'll find me, you'll find the business. Otherwise, jump on to email info@summitfinancewa.com.au.
Awesome, mate. Thank you so much again for your time. And I'm sure everyone will love tuning into this. And as I said, collaborate on this episode with the previous episode with Jeremy on the masterclass. Trusts, solutions from an accounting, from a finance. There are ways around this, and Tom's spilled the beans. So thank you so much. Appreciate it.
Thanks, Arjun.